Get ready. This is Crypto Talk with Mike Willis in 3, 2, 1.
Hello and welcome to Crypto Talk. I'm your host, Mike Willis. For those of you that don't know me, I spent 30 years as a trader and portfolio manager on Wall Street. But in 2018, I became a Bitcoiner. Each week, we look at crypto, we look at the markets and the news that actually matters. So let's get into it. First up, let's pull up the Bitcoin chart and see where we stand this week. The news still, of course, is the heat every one of you is feeling. Back in October, we hit our highs of 126,000. Recently hit our lows at 59,000 2 weeks ago. We had a nice little rally going, made it up to 67,000, but it's feeling more like a fake out move at present. We just dipped below 63. Those of you who've been watching the channel know that I believe we're in tight correlation with this crypto winter here from 2022. If you look at the highs and lows, really tracking it, this is a little steeper angle here than over here. So normally that would mean a shorter base. So we may not have to churn as long as we did in 2022 and 2023 on the floor. So hoping the upside's gonna move a lot quicker here as well. After jumping off the floor of 59,000 and popping up to 67,000, we're now like we're gonna go back and test that 60,000 level. I do believe we're gonna go down and take out the 50,000 stops because that's a nice round number. And technically speaking, we pulled back 70% in 2022. We're only about 50% off of the highs from October. So don't be surprised if we go down and test 50,000 before the rally resumes. I don't see us going down 70%. That would take us to about $35,000, $36,000. I'm thinking that we'll hit that 50,000 level, go into the 40s for a little bit, and then be on our way. That's my take on that. Now let's zoom in on the 7 key data metrics. We have the price at 62,000 right now, 1.2 trillion in market cap, still substantial. Daily volumes around 32 billion, so it's lightened up a little bit. If you remember, it got up into the 70s and $80 billion in the last 24 hours when it was really heating up. We might see that again. Sats per dollar, 1,500 sats per dollar. 20 million coins have been minted. We only have 1 million coins to go. The fee per block is 1 to 3 sats, which is, a sats right now about 15 cents. So what that means is the transactions for each block are running just around 15 cents to get a Bitcoin transaction done, which is excellent. And there's been 700,000+ transactions, Bitcoin transactions in the last week. And Bitcoin dominance remains at 59%, which is what we were at last week. Bitcoin dominance, of course, is what percentage of the overall crypto market cap belongs to Bitcoin. And Bitcoin's sitting as the grandfather at 59%. That's the Bitcoin picture for this week. Let's get into the news. In my 30 years of trading, I can tell you the headlines are constantly changing. What you have to have is an investment strategy that works over the long term. So I always like to ask, what's your crypto plan? Because frankly, most people don't have one. So keep that in the back of your mind as we look at the news. Long term is better than short term, but there's a lot happening and I want to address it. The first article I wanted to take a look at was that Bitcoin doesn't need an Ethereum style yield. This is an article by Michael Saylor on Michael Saylor. Saylor just laid out a 5-layer model he's calling the digital asset stack. Bitcoin stays Bitcoin. And what he's saying is you don't need to stack it. You don't need to inflate it. You don't need to turn it into Ethereum. You build financial products on top of Bitcoin. Strategy's already doing it with several instruments like STRC, and Saylor's saying that this is what the whole asset class should look like going forward. Going down a little further here, Saylor's framework is centered around digital credit as financial instruments built around Bitcoin holdings designed to generate returns while reducing exposure to BTC price volatility. Under this structure, Bitcoin serves as collateral while equity absorbs most of the price risk and credit instruments receive more stable returns. So what they've built here is a capital structure. Bitcoin sits at the bottom, their products sit at the top, and it's important to know their products can fail. Saylor repeatedly referenced strategy style securities such as STRC, the company's perpetual preferred stock, positioning them as a key example of digital credit. Let's skip down a little bit here. Saylor says that Bitcoin's volatility is not a flaw, framing it as a natural feature of high energy capital. And the reason he's saying it's not a flaw is that's how he's able to generate the income. If it wasn't for the volatility of Bitcoin, he wouldn't be able to generate this yield. But we'll get into that in a minute. In his model, instruments like STRC are designed to damp the price swings by sitting above Bitcoin in the capital structure, paying out an income to investors while investors sit around in Bitcoin. While Saylor did not directly discuss STRC's volatility, he said credit instruments can experience varying levels of risk depending on factors such as market stress, liquidity, and investor demand. So Saylor's framing of Bitcoin as digital capital and Strategy's role in issuing digital credit built around Bitcoin, including the view that Bitcoin sales are sometimes required to support the structure. So he concludes the article with saying, if the company's policy is that we won't sell the Bitcoin, then the credit won't have value and the equity won't have value. So there he said it himself. If we, meaning Strategy, won't sell the Bitcoin, then the credit won't have value. So this is a bet on Strategy, not Bitcoin. So what they're not saying is this: Bitcoin just sits at the base. Strategy, BlackRock, and every institution following this playbook builds their financial products on top of it. Banks have always done this. They take an asset people trust and find ways to generate income from it. Gold, real estate, now Bitcoin. But here's the distinction nobody in the article makes. The products built on top are not Bitcoin. If you buy STRC, you're not buying Bitcoin safety. You're buying a financial product that uses Bitcoin as its foundation. That product has credit risk, counterparty risk, and leverage that Bitcoin itself doesn't have. So Bitcoin doesn't have to go to zero if Strategy has a bad quarter, but STRC might. So that's why people panicked when Strategy sold Bitcoin a few weeks back. You remember we talked about, I think it was 32 Bitcoin. It was just a blip on the radar, but because it was the first time he had sold since I think 2022 or something like that, everybody started saying, especially when you're going through a crypto winter and Bitcoin's down 50%, is Strategy going to be forced to unwind? And I think that's the reason you see all these articles on Strategy. Is at the back of everyone's head is, will Strategy have to unwind, and at what point would that affect Strategy and their products before it affects Bitcoin? And Saylor knows that. It's why he treats Bitcoin itself as untouchable as long as he can. But sometimes he can't, and that's what the sale was. All right, let's go to article number 2. Bitcoin is being packaged for income investors, but yield comes with a trade-off. So I put these articles back to back. They're both regarding yield, because I want to make a couple of points here. So as everyone knows, Bitcoin doesn't pay you a dividend. There's no interest, but Wall Street is sold on creating income products around assets. They do it with gold. They do it with just about every product. BlackRock just launched a fund that's promising 15 to 25% annualized returns using Bitcoin. To do that, in Japan, a company called Metaplanet just bought a securities firm specifically to offer Bitcoin-backed investments to Japanese savers who are currently earning almost nothing on their money. And again, interest is a big deal in Japan as well as the United States. So the headline sounds straightforward, but what's actually going on underneath, I want you to understand. So this article reads like it came from BlackRock's PR team. And unfortunately, that's how a lot of financial journalism works nowadays. The journalism part is missing. So when the biggest investment firm in the world launches a product, the press release becomes the story, and that's kind of what happens in this article. BlackRock's BITA fund is promising 15 to 25% annualized returns, but the only threat to yield is not falling prices. Here's what they're not saying. The income BITI generates comes from selling options. This is a common practice where you can sell call options on an underlying asset. You get the time premium of the option. If the stock runs up, the option is called and you lose the upside of that asset. But if it goes flat or down, you get the income for free. And so people love this kind of stuff because it just sounds appealing to have income all the time. I have always been a growth guy. I would rather have the growth. I don't like to give up my upside for income. But in this case, the price of the option is based on how much Bitcoin moves around. So the volatility creates the price of the time premium. So if you have a large amount of volatility, you get a large amount of time premium when you sell these options. So technically what happens when they say they can generate 15 to 25% income, it's because when they do these options, they're getting 1 to 2% per month that they're going out on these options. And that's where that number comes from. In any significant Bitcoin price drop, the fund loses money on the actual Bitcoin it holds, obviously. So the options premiums collected up front might be 1 to 2% of the fund's value, as we talked about, if they just go out a month or so. And then if Bitcoin drops by 30%, that cushion means almost nothing, because so you got 1 to 2%, you're down 30%. So you could be in a situation where the fund is down 28% in value net, and then paying out income that doesn't cover your losses. And the third thing, which the article doesn't talk about, is the upside trade-off. So we talked about this a little bit, but when Bitcoin has a massive run-up, you don't get all of the upside. And this particular product I saw in the article, it talked about you get 70% of the upside, which means you're giving up 30% of that number. So if you're up 20, Bitcoin's up 20%, you're not going to get all of that 20%. And at some point, you're capped out. I didn't see that number in the article, and I didn't dive deep enough into BITA. But most of the times, you write options. At some point, as Bitcoin runs, you get none of that upside because the options, the whole reason somebody's willing to pay you a premium for the option is so they get that upside on that move. So it's not as simple as I'm going to collect income, but if the price drops, income drops. The fund works well when Bitcoin is actively volatile, and it shines in flat markets, and it doesn't protect you in a crash other than you're making a few points in income. My biggest problem with it is you're losing the upside if Bitcoin really takes off. Article number 3. This is kind of a fun one. Coinbase gears up to launch tokenized stock trading, crypto, and equities options. So Coinbase just announced tokenized stocks, equity options, crypto options, borrowing against Solana, and a Bitcoin rewards travel card. Brian Armstrong, who's their CEO, is calling the tokenized stocks real one-to-one ownership. He's saying they're not IOUs, they're not derivatives. You're going to get real dividends. It's going to be on-chain, which would be awesome. All of that stuff is awesome. The goal is simple. One app where you can do everything with your money. But let's take a look at what it really means and what they're leaving out. So what they're not saying. Brian is claiming this is real one-to-one ownership, not IOUs, not derivatives, real shares, real dividends on chain. And that sounds like a big deal. But there are 3 things buried in Coinbase's own footnotes that don't make it into the headlines. First, the product is not available to Americans. In one of the footnotes, it says US persons are excluded. So if you're watching this and getting all excited like I was, it doesn't really change how you and I can use Coinbase, at least not yet. Second, SIPC protection doesn't apply here. Coinbase says so explicitly. The tokenized stocks live on-chain under Coinbase Inc., not under their FINRA-registered broker-dealer. So SIPC was built for traditional custody accounts at clearing brokerage houses to protect them from the failing of the underlying brokerage house. This isn't that. If Coinbase ever runs into a situation they were in 2022, your tokenized Apple shares are in the same pile as everything else. Third, no one has explained how these stocks get priced on Sundays. There's several ways they can do this, but when the exchanges are closed, who's setting the price? There's no price discovery out there. Someone has to set it. So Coinbase hasn't said how they do that. They could have some sort of system where just the buyers and sellers are making their own market. They could take a price at the close, but there's risk to that as well. Arbitrators can come in. There's also something called price oracles. That's exactly what Mirror Protocol tried a while back. They started the tokenized stock trading on a 24/7 basis on its own blockchain. And these price oracles determined what the prices were going to be on these tokens. The problem is when the price oracles weren't accurate, arbitrators came in and either bought or sold the underlying and captured that spread. And eventually, Mirror Protocol got caught on the bad end of that, and they don't exist anymore. So real one-to-one ownership is only as real as the systems behind it. So what Brian is saying, what Coinbase is saying is they're going to buy Apple stock here. So when you buy the token, it's backed one-to-one with the Apple stock. So when the Apple stock kicks out a dividend, it's then paid to you who holds the token. But in the end, that Apple stock is being held by Coinbase. And that's important to understand. Your Apple token is held by you. So yes, it's one-to-one, and yes, this is exciting, but you need to understand there's still some separation here. So who holds the underlying shares? What happens to them if Coinbase goes under? How the price gets set when the market is closed? None of these questions are answered in the article. All of them, of course, matter. So these are the stories on my radar for this week. Now let's go into the numbers. Keep in mind that anything that's happening in the traditional markets always influences crypto. So let's see what's happening in the traditional markets. For 1 week, the S&P was up 2%, flat for the month, up 25% for the year. Bitcoin, on the other hand, up 4% for the week, down almost 20% for the month, and for the year, it's off 27%. So the 1-year delta between TradFi and DeFi, 52%. To put that into real numbers, what that means is if you're 100% crypto and your buddy is 100% S&P 500 equities because he doesn't believe in crypto, There's a 52% spread from his returns and your returns. That's a big gap. All right, so that's a macro picture for this week. Now let's wrap it up. So 30 years on Wall Street has taught me a lot of things. And here's what this week reminded me of. I've seen this before. It was mortgage-backed securities. You've had real mortgages, real homes, people buying packaged products representing these real mortgages and real homes on Wall Street. So real people paying them, and they packaged them and sold them as something that was just like owning the mortgage. But the terms were in the prospectus. Nobody read the prospectus, and we all know how that ended. So Brian Armstrong is calling this real one-to-one ownership. You buy the token of Apple shares here, Apple tokens here. They buy Apple stock here. You get the dividends. It's a one-to-one basis. If you sell the token, they sell the Apple stock, and you get the benefit of that. But Coinbase buried in their own announcement, this isn't available to US people, US citizens. It's not SIPC backed, and nobody's explained how you price it on a Sunday. The headline is never the product. On Wall Street, the headline is often a sales pitch. The footnotes are what you're actually buying. We're still early. I do love these types of announcements because tokenizing Wall Street, 24/7 trading, immediate settlement, these are all the things us Bitcoiners know and love. But early doesn't mean you stop reading the footnotes. It means you got to start reading the footnotes. And on that note, we are wrapped for this week. I'm Mike Willis, and remember, keep one eye on Wall Street and two on crypto.
That's Crypto Talk with Mike Willis. We'll see you next time.